Imagine the silver market reaching $84 an ounce. Physical premiums in Asia are soaring. Industrial demand is reaching a fever pitch, and the market feels unstoppable. Then the New York market opens. As shown on this chart, a wave of profit-taking causes the price to plummet by $10 in the blink of an eye. Market veteran David Morgan notes that bull markets are structurally designed to buck off as many riders as possible. This scare-you-out phase uses breathless moves and violent pullbacks to shake off the weak hands before the market reaches its ultimate peak. To survive this environment, you have to ignore the immediate panic of a daily drop and focus on the hidden mechanics driving the supercycle. Right now, fatigued investors are facing a flood of algorithm-driven hype and blogosphere rumors, leaving them paralyzed by the noise. One viral narrative claims China is preparing to slap strict export restrictions on refined silver starting January 1st, potentially cutting off the world's supply. Meanwhile, traders see an $8 physical premium on the Shanghai Exchange and assume they are looking at an easy, immediate arbitrage opportunity. There is also widespread panic regarding the Chicago Mercantile Exchange hiking margin requirements, with many fearing a deliberate attempt to crush retail traders. Making decisions based on these shifting, unverified narratives often leads investors to buy at the peak of the hype and sell during the resulting panic, a cycle that liquidates retail portfolios before the real move occurs. The reality in China is a new licensing system. Beijing is implementing these new rules to clean up the gray market and track what leaves the country, functioning as a regulatory hurdle rather than a supply chokehold. That Shanghai premium is also more complex than it looks. Executing the trade requires turning raw silver into 1,000-ounce good delivery bars. The current physical backlog at refiners to produce these specific bars makes the arbitrage trade practically impossible to execute. As for the CME margin hikes, requiring more cash backing for open positions is a routine mechanism to flush out over-leveraged traders. We saw the same pattern years ago when the palladium market went vertical. Understanding these moves requires looking at the roles these metals play. Gold serves as a steady monetary anchor, while silver functions as a volatile, emotional sibling, acting more like a high-beta tech stock compared to gold's stability. When the noise is stripped away, these events appear as standard mechanical speed bumps within an aggressive bull cycle. David Morgan manages this volatility with a specific portfolio structure. 75% of the physical silver is kept as a core position that is never touched. The remaining 25% is used to position trade breakouts, locking in profits while the core remains protected. Mathematically segmenting a portfolio this way removes the emotional urge to panic sell the core stack during violent daily price drops. Tracking silver gains in US dollars or yuan presents a problem. You're measuring a hard asset against a currency that can be printed to infinity. In Weimar Germany, the stock market rose continuously, making citizens feel wealthy even as the currency in their hands lost its purchasing power. Only those holding precious metals actually kept pace with the devastation. Measuring a hard asset against a fiat currency is like using a rubber yardstick. The measurement itself distorts reality as the value of the currency degrades. To find true value, you must compare silver to other tangible assets. Ask how many barrels of oil an ounce of silver can buy today, or how it ranks against real estate and the broader stock market. This chart tracks the gold-silver ratio, a key metric for value. In a secular bull market, silver historically outperforms gold at the end of the run, pushing this ratio toward 50 or lower. True wealth preservation requires tracking purchasing power against other hard assets, as the daily dollar price reflects the instability of the currency rather than the value of the metal. The ultimate tragedy of a supercycle is holding silver from $50 up to $100, only to write it all the way back down to $50 without ever securing a dime of profit. Attempting to time the absolute peak is a strategy for amateurs. The professionals don't guess the top, they plan for the ride down. This distribution model illustrates a concrete exit blueprint. Instead of a single exit, you systematically scale out of positions in tranches, locking in profits at rising price intervals. Those profits are then rotated away from silver and into other, currently undervalued hard assets or real estate to preserve the newly captured wealth. The primary purpose of the silver bull is to buck off its riders. Only a disciplined, metric-based exit plan ensures you keep your wealth when the cycle eventually turns.